Okay, we're going to lead the discussion with two of our senior fellows here at the Institute, one on loan from Bruegel, Nicolas Veron. Nicolas, why don't you start off, and then Bill Cline, and I think probably since time is short, address the last part of Luis's proposal, presentation, the proposals for how to resolve the problem, using Spain only as an illustration, but let's not go into depth in Spain. We don't have time to do it. So let's talk about feasibility and desirability of the INET plan. Nicolas.
Thank you, Fred, and thanks for the opportunity to comment on this report, which is very well written and I think very thoughtful in the way it frames the... I was saying the report is, I think, very thoughtful and insightful in the way it frames the European mess. I was struck, before commenting on the report, and very briefly, I was struck by the symbolic of the Rhine, and probably that's because I'm French. In my country, this is, has been important in the past 150 years. But in the longer perspective, clearly, not all European wars have been fought across the Rhine, and my impression is that the sense right now, rather than a north-south crystallization of a complete divide, which, by the way, would keep Mainz and Bonn and Cologne and Antwerp on the southern side, which maybe is a silver lining. I think it's more a sense of all sorts of levees falling apart, all sorts of dead bodies coming back to the surface, like in Michelangelo's Last Judgment. And Catalonia is really the emblem of that. I mean, Catalonia really doesn't, it's not a problem that comes out of the blue. This is a problem that is real, has never been settled, and right now you start hearing about events that happened in 1469 and 1714 as if it was yesterday. It really sounds like the Middle East, and well, I have a bit of a bias here, I have to say, because I know Catalonia better than I know the rest of Spain, but the point here is to say we're seeing very abrupt shifts in political balances or imbalances in European countries, and they happen very quickly. If you look at other examples, what happened with France and banking union, we had a discussion here some time ago with Jessica Einhorn, and she really had this point, which is very true, that the French have hold to their sovereignty over banking policy very strongly over the recent past, as far as anyone can remember, and suddenly France becomes a powerful advocate of banking union. Same with the Netherlands. We had this very clear pictures of the parties on the extreme gaining momentum, and suddenly a big reversal. So I'm not drawing conclusions here. What I want to point to is the extreme political volatility that we have seen since the start of this year. And it's not extremism, at least not yet. But it adds to the uncertainty, and we see these very abrupt shifts in political economy, which I think we will see more of in the next few months. Now, back to INET. One thing, I'm not going to comment on all aspects of the proposals, but really look at the very big point, I think, which is this idea of having a minimum level of integration going forward. I think one point which is very important in the INET report is the view on growth. And I think very rightly what the report puts forward is a question of integrity of the Eurozone and availability of credit as what will determine the return of growth to the periphery or to the debtor countries, to use your terminology. I think this is important because many people still frame the return of growth in terms of policy choices in those countries as a question of stimulus. How can we inject funds? But this actually is a second-order factor, important as it is, compared to the return of credit, and very simply the fact that people will not invest as long as there is redenomination risk. And this redenomination risk, unfortunately, is not just about Greece, it's about Spain. And if Greece exits the Eurozone, God forbid, it will become very directly about Spain, as harshly as it is currently about Greece. So the big question raised by the report, in my view, is how much integration is enough. And here it's very interesting because there are really reasonable people can disagree strongly on this. If I take only our Spanish experts, yesterday we had Angel Ubide saying basically banking union is a sideshow, what is important is Eurobonds. And today we have you, Luis, saying Eurobonds is a sideshow, actually is not necessary. What is important is banking union. So we see, even from the same country, which can introduce a cognitive bias, as we know, we see two completely opposite positions. And then we have other things coming into the picture, such as the proposal you mentioned, which I think is important in the debate going forward, by Thomas Philippon and actually the French finance minister of joint unemployment insurance in Europe, which is neither banking union nor fiscal union, it's call it social union or welfare union. And I think we'll see more of these sorts of proposals going forward. My view here, which may be a bit too radical, but which I think has not been disproved by facts, is that this sort of choice between fiscal union and banking union perhaps were possible in 2009, perhaps were still possible in 2010. In 2009, we certainly, and actually Adam Posen and I advocated this in a paper more than 3 years ago, we certainly could have resolved the crisis with energetic, resolute action in the banking sector. And call it banking union or not, but we would not have had the developments we have had since. In 2010, probably it would have been possible to restructure Greek debt and call it a day. Now, I'm less sure. I think now there will be no resolution of the crisis, given all the time that has been lost, given all the opportunities that have been missed, given all the dysfunction in our European policymaking mechanism. I'm not sure the euro can be saved without a combination of banking union, fiscal union, and the increased democratic accountability at the Eurozone level and representation, call it political union, that is indispensable to make this work. So I'm not sure that your minimal agenda still holds, given all the time lost. Just a few last comments. I think the idea of catastrophic loss insurance, which is in your report, is very interesting. And so that's the idea that when there are losses in the banking system, you can have, say, 20% of GDP borne by the national budget. But beyond this limit, here comes a European guarantee. And of course, it's an unlimited guarantee, but there is a sort of first loss at the national level. The other point, which I'm less sure I share, but leave open for the debate, is the idea that financial reform and ending too big to fail is a prerequisite to action. And I think there is a bit of a moralistic tinge to this, which is not unlike what we hear from our German friends. You know, there is this enormous scandal, moral hazard, we have to resolve it before we can do anything else, and I'm not sure this is conducive to action.
Did we wrote the word prerequisite?
Yeah, the word prerequisite is in the report. I was struck by that.
I apologize.
And this is very concrete, because we'll have in a couple of days proposals by Erkki Liikanen and his group on structural financial reform in Europe. And I mean, I have a lot of sympathy for this agenda. Actually, I think it is necessary to think very hard about it. But I'm a bit worried by the notion that you could, have a loss of priorities here. Some things are really urgent, the house is burning, as everybody says, and some things are more structural. So I think the sense of priorities and the focus on crisis resolution in a sustainable framework is really what is needed now. Thank you.
Let me congratulate the INET group. It's a very sober, thoughtful document by an impressive group of economists. I was very much informed by the focus of the presentation on Spain, and it sharply reminded me that Spain and Ireland are real estate bubble cases where the locus of the problem goes from, as a consequence, the banks to the sovereign. And of course, Italy and Greece are very different, each in its own way. But let me focus not so much on the presentation on Spain, but on the INET document. This document was written July 23rd. It had a bolded drifting toward breakdown. Well, I think that's now looks a little too pessimistic. I think there was a sea change with the ECB announcement of outright monetary transactions. And much of the institutional change called for seems in some sense to be underway, certainly not in hand. maybe INET should take credit for the ECB decision, because implicitly it was the kind of thing that was being called for. I think the document is vague on macro measures to restore growth. It seems to imply a 5-year suspension of fiscal adjustment. And it seems to me that that would risk unraveling of the restoration of market access. Nicolas was suggesting, and you were suggesting, that instead it has more to do with credit. I'd like to hear a little bit more from you on that point. What is the substance of the growth plan that you see? The document argues at one point that Germany, Finland, Netherlands are responsible for the problems of Greece and Portugal because they signed on to a flawed Eurozone project. Well, that's not very convincing to me, and I'm sure it's not going to be convincing to the Germans. More relevant is that it is in Germany's own interest to ensure against a blow-up at this point, because the cost to them would be extremely high, and that any needed topping up of transfers to the likes of Greece are going to be a tiny fraction of the losses avoided by avoiding the blow-up. The statement seems to go back and forth on Eurobonds. At first, they are rejected as politically infeasible, but later, the German and Council of Economic Experts proposal is supported. Yet this is a massive redemption of existing debt. Surely this would raise questions of political feasibility also, not the least of which is the earmarking of fiscal revenue that would be required by the countries having their debt redeemed. I proposed in June an alternative approach to Eurobonds, which is Eurobonds with country-specific insurance premium that would be paid into a sinking fund as insurance against default. If Italy and Spain paid a 250 basis point insurance premium and there were mutual Eurobonds that could call on that in the event of a default, it seems to me that that could be more politically feasible than what we have heard so far. There could be an annual review of eligibility of borrowing in that year. Now, when the document spends so much time on SBs, I begin to scratch my head. I think there's a red herring of the diagnosis and a distraction of the solution. I think it's a red herring of the diagnosis to imply that the reason we're in this mess is that the Spanish banks couldn't think of any safe instruments other than Spanish sovereign bonds. Well, come on. They could have bought treasury bills. And yet that seems to be the diagnosis. I think that's a red herring. I think that it is a distraction to think that the problem will disappear if you have SBs. You'll still have people getting out of a country where it looks like the sovereign's going to default. So I would like to reserve judgment a little bit because I'd like to think about SBs more, and it's a very distinguished group of people who've come up with them, and maybe I'm missing the point, but I think in terms of going forward operationally in the near term, it's not clear to me that SBs is the right way to think about it. There is something in the presentation that I didn't pick up reading the document. It seems to talk about guaranteeing going forward. It's on slide number 60 in your handout. Could you please say some more about that? Or maybe that's just sort of a, maybe I misunderstood that. Maybe that's just a different way of talking about the ECB's, the ECB's, here I'll show you, page 60. Intervention. The proposal for catastrophic insurance, that if you have a bank loss, it's more than 20% of GDP, it gets picked up by the Eurozone. If it's less than 20%, it gets picked up by the country. I mean, I think that's worth thinking about, especially now that there's been backtracking on the ESM coverage of the Spanish losses. Although I would emphasize that the Spanish bank losses are in the order of 5 to 10% of GDP. As I'll say briefly later, that would still bump up the Spanish debt ratio to a manageable level. So I don't think that that is a fatal blow. It's not an encouraging development, however. I think there's a somewhat dangerous paragraph that sort of says voluntary debt relief could be a great idea. I think that's a very slippery slope, especially if anybody were to start thinking about that for Italy or for Spain. It is imperative to maintain the fundamental diagnosis of solvency and non-subordination of private investors. The minute the private investor thinks he's going to have a subordinated paper in a situation where there could be a haircut and therefore a concentration of the haircut on the subordinated paper, you shut off those inflows. So I think that's a little bit, it may be necessary. That's a Greece and conceivably Portugal, Ireland story. I fully agree with the paper's diagnosis that Spain and Italy, that quote, for Spain and Italy, we are dealing with self-fulfilling fiscal crises. Well, what's that mean? That means that at reasonable interest rates that are not in the bad state, they're solvent countries. And the paper that is included in your handout that I did using a probabilistic approach to debt forecasts for both Spain and Italy and looking at correlations of good and bad scenarios takes the central view that they are both solvent, that because of a high primary surplus, Italy's debt ratio should come down from about 125% to about 105% by 2020, that in Spain, you're starting from a lower level, and even with the increase, you should not get above about 90%. Well, guess where France is right now, 90%. So I agree with the solvency diagnosis. The paper, I think, also shows, however, that achieving the primary surplus is crucial, especially for Italy, something like 5.5% of GDP. Spain's primary surplus is actually fairly modest. These need to be achieved because if they aren't, then things start to spiral out of control. And there again, I become a little bit concerned that some could read the statement as saying, don't have to worry about meeting these primary surplus targets for the next 5 years because it's more important to get a fiscal stimulus. I'll stop there.
Time is short. We're going to run to about 10:15, 10:20. I want to give time to the audience for questions. I want to give time for Luis to come back with responses. So I just want to ask one additional question myself. Luis, you stressed, and I think rightly in your presentation, the need to stop the capital flight. But you did not talk at all about the size of the firewalls that have been built to try to assure markets against the effect of excessive capital flight. Now, most American crisis fighters over the last 2 decades have espoused what we call the Powell Doctrine, the Colin Powell Doctrine, after the former chairman of the Joint Chiefs, who said, you use overwhelming firepower, and that's the way not to have to shoot. How come the INET group, which makes courageous and innovative proposals in other areas, some of which do run into questions about political feasibility, how come you didn't bring that in? I'm with Bill Cline. The Germans have such an overwhelming interest in holding this thing together in terms of the historical legacy, including its moral aspects, including the economic advantage of being the world's biggest surplus country and having a weak currency. It's nirvana for the Germans. And I therefore conclude, and I've checked it out with a lot of Germans, they'll basically pay anything. So why not put together a sufficiently large firewall to assure the markets that the contagion won't happen, that the capital flight can be covered, and try to get them to give it up? To me, that's a big, big omission in the report that you've put together, and I'm curious why you didn't include it.
So I start with that last question. That's a great question, and I think the answer is really plain old political feasibility. I mean, the ESM is at the level that it is, as you all know, is totally not sufficient for Spain. Happily, I think the Bazooka is a decision by the European Central Bank in early September. I think that once the European Central Bank announces that Spain has asked for a program, and Spain is in the program, and that means they can do unlimited. Remember, this is unlimited. It's conditional, but it's unlimited. As long as Spain is a good kid, it can get unlimited support. And I think that's going to be the Bazooka that's going to stop there. That's going to stop. So very quickly on the other questions, I apologize. Not my co-drafter, but myself is responsible for the financial reform. So the prerequisite is my word, and we didn't think that a prerequisite of everything was a financial. It's a wrong use of the word. We mean it's part. It has to be part of the package. On the Eurobonds and political feasibility. And do we need Eurobonds and are the SBs sufficient? And also related to the slide 60. Well, the slide 60 is still doing the past. Okay, we do think that looking towards the past, you need a mechanism to get these debts digested. I mean, Spain and Ireland are not going to digest this banking debt on their own. I don't think it's going to be possible. Yes, it's now 10% of GDP. That's true, the extent of the banking losses, but there's a risk in the tail that needs to be taken care of as well. I think that the reason that we think the SBs and the default are possible for the future is because just think about the banking systems being completely safe from contagion from their own country. So basically, think of the Arkansas Bank, which has treasury bills from the U.S. That Arkansas Bank can face an Arkansas state collapse without any problem. Then Arkansas has the right incentives to behave. So once you have a banking union, and once you have a backstop for the banks that is common, and once you have an asset that is shared and that doesn't have these flight to liquidity properties, you don't need that sharing into the future. And you're saying, well, was the bank in Santander stupid enough not to have, why didn't they have bonds and they chose to have Spanish treasuries? Banks are doing the right thing because from their perspective, think about it. In the state of the world where the Spanish treasury goes bankrupt today, as things stand, the bank is toast anyway. So in that state of the world, you're right to get those bonds, okay? You have to prevent them from doing that. And plus, you have this extra thing, which is you have the call from the general director of the treasury. We have a Spanish civil servant here who was in the treasury before, and we could ask him. But the way these bonds get sold is not in the quote market, right? The way they get sold is like you make a call, and the general director of the treasury calls all the banks and says you have to quote bid. I'm saying quote because for 100 million, because that's your share of the Spanish banking sector. I mean, that happens in every country. Treasury auctions, when we talked about SBs in the Italian treasury, they said, well, what's going to happen to our funding costs? Well, your funding costs on the steady state will be higher if you're misbehaving. Well, we don't like that. It's like, yeah, you love financial repression. Financial repression is great. You just told your banks, buy these things at low rates, and I'm very happy as the state. But that is exactly the loop that we want to break. So I do think that on both sides of the debate, once the banking backstop exists and once the states, the systemic contagion is stopped that way, the SBs would be enough. So that deals with the slide 60, which is about sharing towards the back. And dangerous, the voluntary debt restructuring, I mean, yes, I mean, it should be, at the moment, it should be like a very, very last resort. I hope it can be avoided. What I would hope for a place like Spain or like Ireland is that we find sub-sovereign institutions that can default and that don't push the state into default. That would be the idea. I think I've not dealt with every single thing, but okay. I stop there.
All right, let's open it up to the floor. Raise your hand, either go to the mic in the back, standing mic, take a traveling mic here, identify yourself and fire away. Floor is open. Yes, go to the standing mic.
Alessandro Pio from Asian Development Bank. I think clearly the concern is on short-term solutions to get us over the short-term issues, but my main worry is about sources of long-term growth. And looking at financial instruments is because the growth is the one that's eventually going to sort out reduce the cost of unemployment, subsidies, increase tax revenues, and all the good things we know. Has any thought been given to some sort of European project bonds that could essentially allow the financing of long-term growth solutions, whether it's infrastructure investment, whether it's investment in education, the kind of things that development banks do? We have a longer time return, but would allow the financing to be in a way possibly with help by the European Investment Bank in terms of design of the projects to ensure the viability, that would allow some sort of European mechanism for funding the growth that at the moment these countries don't find any other source of financing from.
So this brings me to something I didn't answer from you, which is that I am doing a research presentation this afternoon on another conference, and basically presenting evidence on financial constraints on Spanish firms and how that affects their growth. I mean, I do think that we are in a liquidity crunch, and that the country has a lot of unused resources. There's a lot of educated kids who are now unemployed. I think investors could pour money the moment the euro risk is gone and the moment the financial blood starts flowing. So we do think that maybe there is scope for some of that, but we do think that the banking and financial kind of getting this sorted out is a necessary and hopefully a big part of the solution. I mean, you know that Spain is in itself a big Keynesian monument for the last 12 years. I mean, there's a lot of roads and highways. My American friends, when they visit, I have very good American friends that spend the summer with me, and they are stunned by, they say like, oh, a highway like this in the middle of the plains in Spain, I've never seen in the US, you know. So there is a scope for sure. Obviously there is a scope. You could do fiber optic, you could do a lot of things, internet, but I think the priority has to be, I agree with Nicolas, you know, we don't want to have so many priorities that we lose track, and here the priority is to just get all this overhang moved out and the credit.
But there already is a minor or modest program of project bonds, is there not, through the European Investment Bank? I mean, some of it's been packaged from before. More could be done. That was discussed, I think, back at the June summit. So there is something of that type in train, and I guess the question is, how big could it responsibly be, and how helpful?
Yeah, I think much rather for me would be that the Germans start consuming, start raising wages. And I mean, they've had, 12 years of virtually no wage growth. I mean, I think this is now the moment to start reversing that.
Yeah, to put that in the vernacular, the Germans have achieved a huge internal devaluation. Mm-hmm. And so what they now need is an internal revaluation.
Yes, that would help.
And that's got to be an important part of any solution.
Yes.
Okay, other questions? Yes, John. Please identify.
Yeah, my name is Bung Tran from the Institute of International Finance. I just want to bring to your attention the point that you referred to unlimited bond by the ECB. And I would like to caution that we should be careful in terms of what we ought to expect, because unreasonable expectation might lead to deeper disappointment later on. In fact, the ECB never said they would engage in unlimited buying of bonds. What they said on 6/6 is that ECB will buy bonds if conditions are met, with no ex-ante limits on the amount of the OMT, which to me connote a slightly different connotation.
So I mean, to me, what you want is to stop the run, and you want to stop the panic. And the question is whether the kind of support the ECB gives. I mean, the conditionality is an issue. If that worries us, I'm happy to discuss it. I mean, the conditionality does mean that the ECB is putting itself a bit at the mercy of the politicians. But in terms of what it can do, I think it can stop the run. I mean, I think they really do have the ability to say, we are. I mean, to the extent that they can provide that unlimited support, I do think they have the ability to stop to backstop both the country debts and as they are doing the financial system.
Barry?
Barry Wood, Emerging Markets. I was interested in what you said about the ESM being totally inadequate for Spanish needs. So what does that imply for the next few months? Will they have to come to the fund for money? What do you see?
I would be delighted if they come to the fund. I think our experience on the Greece and Ireland rescues has been, I don't know if you would share this, having a much better view of the fund than we have from there. has been that the fund has taken a much more neutral view of the needs of the states than the creditors. The bank, really, the European Central Bank, in my modest view, shouldn't be in the Troika. They really are mostly concerned with the balance sheet of the European Central Bank, which is loaded with all this stuff. And the more loaded it is, the more they behave strictly like a creditor, and not like somebody who's trying to get the citizens of the country to kind of get out of this rot. And I think the IMF, in all of these discussions, has been much more helpful. I don't know that they would be. I don't know that you could convince, Ecuador or Mali that the best way to use their money is to lend it to Spain. But I mean, I think that there is an issue of how much money the IMF should be lending to developed countries that will be politically tricky. But I would very much like the IMF to be involved, and I think that indeed it's actually something that could be helpful in terms of reforms and less austerity, more reforms, kind of, which is what I think is needed for Spain.
Could I ask you about the consistency of two things you've just said? In answer to my earlier question, you pointed to the ECB as the bazooka. Now you said you want them out of the Troika. If they're going to be relied on for the funding, there is going to be the conditionality element. But you now say you want to take them out of any direct responsibility for the conditionality element.
I mean,
Question, is that feasible, or don't we just have to admit that in the current real world in Europe, the ECB has to function as a supranational government, not having a government to refer to, like the Fed and other central banks. Thus, it's a sui generis central bank. And so why don't we just kind of recognize and admit that? And again, I'm puzzled that you don't put those pieces together.
I don't agree with the presumption. Actually, if I was the ECB, I would like not to be involved. I think the ECB takes huge risks going into the countries and telling people what to do. They don't really have the expertise to do these things. They haven't run programs in the past. And I think that having an honest broker that they can point to, that, look, this is what the IMF, who are the experts and they are not involved, is telling you. If I was the ECB, I would actually much rather prefer it than being directly getting my hands dirty with matters in the member states.
So then I presume part of your answer to the question about the bazooka or the overwhelming firepower is to mobilize the IMF in a pretty big way.
I would want to mobilize the IMF intellectually, and I would hope that it wouldn't be necessary to mobilize the IMF financially. I think that the hope that, as Nicolas is saying, as the crisis advances, some of the hopes we have to be revised. But the hope that we're getting today in Spain, the very good start of the banking resolution over the next 2 weeks with the bad bank as well, that the applying to the program will remove a lot of the self-fulfilling fiscal crisis aspects. I would hope that the bazooka, like Paulson said, would not need to be used. I know that Paulson had to use it. So,
Bill, yeah, two-handed.
Yeah. My view of the IMF, if it comes in big volume, is it's the kiss of death, because you have precisely the quintessential subordination problem. I even worry about the ESM. The ESM, it turns out, if you pour through the fine print and pronouncements, it's senior. One of the best things the ECB did was to say it's pari passu. So my ideal, if the IMF gets involved, is that it provides intellectual guidance,
yeah,
but it doesn't send a lot of money.
Yeah, I fully subscribe to that.
Okay, Phil.
Phil Levy, University of Virginia, Darden School of Business. I wanted to ask about the part where you're talking about institutional reform and what comes in the future, setting aside the legacy. And you put forward this idea of a more minimal approach, saying it doesn't have to go all the way towards political union. I was hoping you might elaborate more on how you would draw that dividing line. When you were talking about, for example, the politics in Spain, an awful lot of these seem to revolve around payments. And so where does one sort of divide and say these are political matters and these are economic matters, and how would one differentiate that in the sort of future Europe that you envision?
So yes, Catalonia is very much having the same problem as Germany has, which is like we want to keep our money, right? And Wilders in the Netherlands ran a campaign on "We want to keep our money." I think that the key issue is as much political union as the banking union requires, which is mostly a technical matter. And I don't think, and I know I would be in the minority in the States. In the States, people tend to think, look, you go all the way to Hamilton, or you're nowhere. And I think that we can try to craft. Europe has always been in those places. I think we can try to craft a solution. I mean, I'm not saying my first best. I am pro-European. I started as a coach of Europe. I've been a European since 7. I mean, if you ask me, like, do you want the European super state that everybody the rights? Yes, certainly. Okay, but that's not going to happen, and we have to just be realistic and understand what's going on. And what's going on is we have to serve the citizens' needs. And serving the citizens' needs now means not dreaming constructions which are chimeras in the air, but just saying, what is it that we need to break this disaster? And that is, in my opinion, banking union, minimal backward mutualization, and a Eurobond without joint liability.
One quick follow-up. Would the center have veto power over country budgets?
Well, I mean, the fiscal compact has already a gigantic intrusion from the center. I don't think we need to go much further than that. I mean, I think that Nicolas, you wanted to. I was seeing you.
No, I'd like to make a connection between the questions that Phil just asked and the previous discussion, which I found very interesting about the Troika. And I think if you think of the Troika, there's a sort of reasoning by elimination, right? The ECB, as Fred, I think, very rightly said, is becoming the dictatorial government of the Eurozone. And this is both inevitable and unacceptable. So basically, it shouldn't last too long, because as in the Roman Republic, if a dictator lasts more than 6 months, there's a problem. So
He gets killed.
well, in the Roman Republic, it was a commitment device, and I think it was effective for some time, and at some point it had to be revised. But the point is, if it's not the ECB, and if the IMF, I think we rightly all agreed with Bill on, can only be a trusted consultant, then, well, the third member of the Troika that nobody mentions is the European Commission, and nobody mentions it, and apologies to the representatives of the European Commission, because it hasn't been very salient in the policy debate so far. And the reason for that, I think we can agree on, is not because they're incompetent, but just because they don't have the authority to take the sort of roles that would be to say, you know, guys, here's the deal. So by elimination, if it's neither the ECB, neither the IMF, neither the Commission, then who is it? And I think this is a very relevant question that connects directly to what Phil was asking. I think we have a major deficit of executive authority in the Eurozone right now, which I would say has been at the center of the crisis since the beginning and is more and more at the center of the crisis and can be related to the famous democratic deficit of European institutions. The democratic deficit doesn't result in authoritarianism right now, or at least not explicitly. Maybe it is putting Mr. Draghi in the position of the Roman dictator, and I don't know what that means for his future health, but it is resulting in the inability to make decisions. And I think this question of executive authority, which is difficult, it's political, it's not primarily an economic question, unfortunately is front and center in everything we discuss.
The depiction of Draghi as the Roman dictator, incidentally, is of course quite apt in light of what he and Trichet did to Berlusconi a year ago.
And it's kind of an unforgettable image. I don't think it'll go off my head, the Draghi with a white.
Well, it cannot display the image of the Prussian helmet, I'm afraid.
One more question over here.
Thank you. Yalman Onoran from Bloomberg News. From your presentation, I understand why you say the legacy costs have to be shared, and you know that without that you can't go forward. But then another part of your debate presentation, you were also saying how giving examples from the United States, where when we're in a crisis, Connecticut is paying the bill while Utah is in recession, but nobody's complaining about that. But then you're saying in the future, going forward, with after the legacy costs are taken care of, that there doesn't have to be this kind of a transfer union. But I see an inconsistency between the US example, which is the federal example that has worked, and the European example. Not only should the legacy cost be shared somehow, maybe the sharing formula has to be agreed more politically between the North and the South, but the future there has to be some kind of a transfer union, because again, a backstop is needed for a system, monetary and fiscal, to work together.
The proposal does have a formula. So the idea is the banking union means beyond catastrophic losses, the losses are absorbed. So we believe, let me give you the exact analysis we make, which is we believe the banking sharing is absolutely required because those are gigantic numbers and they can sink a state and the whole banking system with the state. We believe the unemployment sharing, exactly the position of Moscovici that he was outlining, the minister that the minister was outlining recently. I would want an unemployment insurance sharing, but I don't think that's necessary for the union to work, and I honestly don't think it's politically feasible now. If we have another document like this, I will fight even harder to try to get that in the document. So I would like to have it, but our view is that it's not necessary for Europe to subsist to have those welfare costs be shared, whereas it's necessary to have the banking union for a monetary union to exist. So that's the formula. The formula is sharing of all banking costs beyond 20% of GDP and nothing else.
Okay. Anybody else? One more question. Jennifer Harris from the State Department.
Yeah, just quickly, bringing it sort of back to where we began with Adam Posen. I was curious if you all gave any thought to the UK Bank of England's new funding for lending scheme. Speaking briefly with your colleague, it sounded like perhaps you had, but decided it was a political non-starter. But as political non-starters here go, I would be curious for your thoughts on where in the spectrum of the impossible that lies. And
what
also
the UK doing? What? Sorry, say again.
The funding for lending scheme that sort of incentivizes UK banks to lend, and there was some debate as to whether that was perhaps applicable to the American example closer to 2009, and obviously there's reason to consider it again for Europe. But when we're talking about what intellectual role the IMF could play, is thinking about conditionality along the lines of this UK scheme.
I think the name of the game for Europe, particularly for Spain and for Ireland, is the leveraging. We have to find ways. I mean, the lending will start when this debt overhang goes away. So part of it is sharing the debt out, as we were saying. But part of it, I mean, the U.S., how has the U.S. delivered? It's pretty amazing when you look at the numbers. I mean, in 4 years, things are really moving. Why? Because of individual bankruptcies. I mean, people have just gone bankrupt. People don't pay. The huge leverages don't get solved by people just little by little paying back their bills. So I think that the intellectual here steps that we need to make, and I don't really know what's the right way to do it, is to start thinking of defaults in a much more constructive and much more, not defaults of countries, but defaults of individuals, defaults of corporations in a more constructive way. Because what is happening right now in Ireland and Spain is that all of this private debt ends up in the public. So to me, the new lending will follow once we have the bankings solved and once we have the families start to kind of be able to deal with the debt. So that's for me the priority.
Nicola?
Yeah, I would connect Jennifer Harris' question to what Alessandro Pio asked before, and this is really the question of where will credit come from? It's not going to come from the banks, as Luis said, they're deleveraging. What sort of alternative sources of credit do we have? And credit will be crucial to have growth in the European economy going forward. I think there's a temptation to have credit flowing from the public sector. And it's probably inevitable that there will be a lot of public credit allocation in the years to come, and it has to be organized in a way that is as incentive compatible as possible so that we don't have a huge politicization of this. But at the same time, I don't think, especially given the political history of many of those countries, I don't think it would be wise to say, well, okay, we nationalize credit for the time being, and that's what we do to get the economy started again. This is where the banking union question is so crucial. We need absolutely to restore private sector credit in the economy. It won't, new banks coming in, welcome Bank of America, or JP Morgan. market mechanisms, more securitization, more bond issuance, things like that, shadow banking, you name it. We will need to pull all the levers of credit in Europe, and I think the thinking in Europe right now about this is much too timid and defensive, because some of the words I have said, JP Morgan, securitization, shadow banking, they're bad words in Europe. They're not welcome. But I think we desperately need them. So basically the aim has to be to break the doom loop, to break the sort of financial repression, Gonzalo's call that Luis described so vividly 10 minutes ago. And this is why banking union is front and center, and we see how difficult it is to achieve, but really the ball on which we have to keep our eye on is private sector credit. If we don't have private sector credit, we won't manage it.
And the Spanish banks, hopefully in 3 weeks' time, will be among the best capitalized in the world. That's the hope. I mean, once this exercise is done, we get the bad bank. A lot of these assets are going to be off their balance sheets. They're going to be in a bad bank vehicle. And once that happens, I think it's probably being released as we speak. But I think the analysis is being conducted in a very thorough manner, and it's being conducted by Oliver Wyman, an external expert. And I think it will be credible, at least I hope really strongly. And so once the doubts are gone, once the recapitalization is in place, if we can ensure the solvency of the Spanish state, which also should be a question of days with this new application to this program, I would think that suddenly, I mean, the corner can be turned. Exports are there. I mean, this has a big element of self-fulfilling panic. And look at Indonesia. Look at all the Asian countries. They got the institutions right. They got the reforms right. They did devalue, of course, and there they are. So that's the hope.
Luis, thank you very much for bringing us the report. Thanks to Rob and his colleagues at INET for sponsoring it. It's incredibly timely, very important, incredibly thought-provoking. So we thank you all. We're delighted to host the event here. Thanks to all of you for coming, and we'll continue this discussion, I am very sure. Thanks to all.